Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So main rules on technical analysis, two main rules. We will study two main rules: supports and resistances, and then trends. So as you can see, a support is an area you can see on a chart of any kind of underlying. It could be a stock, Forex, or a commodity. We have seen in the precedent slide that decisions are partly due to psychology reasons, and that's why when, for example, a price reaches a certain level, people tend to, in the case of a support, to buy again this level because they know that in the past this level has already been hit and has not been broken down. So they believe that if this level has been hit 2 times in the past and not broken down, the price rebounded on this level. There is a great opportunity for the trader to buy again this stock a third time to take advantage of this support. This is the opposite for the resistance. This is a level where when the stock is prevented from rising above this level each time it reaches this level. At the opposite, when a support or a resistance is broken, it means that the movement will be of a great intensity movement on the other side. For example, if you break above this resistance, the movement will be very, very strong, and this is very useful for traders. If you want to sell, for example, on this kind of chart, you know exactly where to set your stop loss level as a resistance level. So, for example, you can sell at this point, you win some money. You can sell again on this point, you win again some money. But if the price breaks up the resistance, then your stop loss is very well identified, and you can enter the opposite position, stop your position, and buy the stock for a stop and reverse position, and then earn a lot of money. You can see an example on this chart with a resistance which becomes a support. You can see on the left many the price hit 3 times the resistance level at this level 150.25, and once if you, for example, if you sell at this point, it was if you sell at this point, you can earn a lot of money. But if you sell on this point and your stop loss is very well identified, once your stop loss is hit, you can stop and reverse the position to take advantage of the new uptrend. So, and you can see that the former support level now becomes a resistance. The former resistance level now becomes a support, and a very nice support, because the new support is hit at several times again, 1, 2, 3, and it breaks breaks down this new support at the fourth time the price attempt to check to test this support. So as you can see, it works 3 times as a resistance and 3 times as a support. It often happens that the support or resistance break the price break its support or resistance level at the fourth attempt. But so let's have a view on trends. You may know the sentence, trend is your friend. This is often relevant when the prices are going up. A nice way to earn money is to buy the stock of the underlying to take advantage of the trend. So we can see here 3 kinds of trends: ascending channels, descending channels, and range. A range is a kind of horizontal channel which is moving sideways. This is a sideways market when investors don't really know where the market is moving. It often range. Markets are ranging during 80% of the time, and this is a nice opportunity to buy on the top, to sell on top, and buy on the bottom. Ascending channel and descending channels are more interesting on the if you are investors on a short-term basis. When I mean short-term, I mean some days to some weeks. This is our time horizon on the FX options recommendation we provide. So as you can see, this is in the case of the ascending channel, this is successive higher peaks and higher lows. Higher peaks and higher lows. It means a continuation of the trend. It is the exactly opposite for the descending channel, with successive lower peaks and lower lows. Lower peaks and lower lows. Continuation of the downtrend. So when you reach the upper boundary of the descending channel, the greatest opportunity for a trader is to sell at this point, to take advantage of this pullback and to follow the trend. Here you can see some example on a very short-term position. As you can see, this is a 30 minutes chart on FX products. Here you have a daily chart. So as you can see in this first example of an ascending channel, the prices, the peaks are higher and low higher too. So the ascending channel is well defined when you have at least when the line at least three times the price touches 3 times the line. You can see on this upper boundary. And the opportunity for the trader is to buy at this point on the lower boundary of the ascending channel, to take advantage of the pullback, to enter into the bullish trend.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.